Hello, in this lecture we will continue on chapter 25 and we'll discuss the relevant costs and benefits. So, we're going to talk about the decision-making process first and then go into types of decision-making process examples. We're going to concentrate on the areas, of course, where the decision-making process breaks down. So, for the most part, our decision-makings that we make every day, we make many decisions every day, and usually we make them fairly intuitively, and we have a very good sense of doing that. Most of the decisions we make fairly intuitively. If we wake up in the morning, we will decide what we want to eat for breakfast, and we'll make that decision pretty quickly, and it's usually a pretty good one. But if we make any larger decisions, many of the long-term decisions that have a long-term effect on us, such as in our personal lives, buying a house or buying a car, then we may go through more of a formal process. And of course, as managerial accounting decisions, in this case, we have similar activities that will happen. If we have activities that are short in nature, that can be changed easily, and that do not have as long-term an effect, then we can make somewhat intuitive decisions, and we have to, in order to make the necessary decisions needed. But if we're going to make a decision that's going to affect a long process in the future, if we're making decisions that are harder for us to reverse and change or alter, or will cause disturbance if we do so, then it would really be beneficial for us to consider a formal process such as this. So this can be applied, like I said, to any large type of decision. We're going to first define the decision task. This seems like a simple thing, but many times the task is not as clearly defined than we think it should be, and that makes it a lot harder, obviously, to analyze a particular decision. And then once we have the task, then we're going to identify alternative courses of actions. So then we're going to kind of brainstorm at that point and say, well, what could we do in this to achieve this particular task? Once we have those alternative options, then we can collect relevant information on the alternative options. So once we have a detailed list of the options, then we can break into those options and say, okay, what's it going to cost? What's the benefit and the cost for those options? And then, of course, we can then take that information and select the preferred course of action. Once that has done, then we analyze and assess the decisions made. So that's going to be the continual process that we will have. We're always going to assess the decision made and then look and see in the future what should future decisions be made. Should we go through a similar process? Was it a good process to go through? Can we improve the process in the future? So relevant costs are what we're going to talk about first, and those are going to be costs that are applicable to a particular decision. They are going to be costs that should have a bearing on which alternative a manager selects. And these two things, they seem like they would be obvious again, but they're really not that obvious, right? If we're taking a look at two different decisions, we want any cost that's going to be the same for those two particular decisions aren't something that we really need to consider, because they're going to be there in either of the decisions that we make. So we're going to really try to focus down on, between the decisions that we want to make, what are the things that are different? And if we can narrow down on those things that are different, those are the things that we believe are relevant, and those are the things that we should consider when choosing between different decisions. So, are there any costs that are avoidable? Future costs that differ between alternatives are types of things that we're going to want to look at when we take a look at these costs. So, for example, if we took a look at some of the accounting expenses that we have, they may not necessarily be relevant. One example is something like depreciation. If we're trying to decide if we want to keep an piece of equipment or buy a new one, the depreciation is an expense of it, but it's not really a cost of the current period, because remember, depreciation is the allocation of the cost over a certain time period. We already paid for it in the past. So when we're thinking about the decision to buy or sell at this point, the depreciation, although it's an expense, isn't really a relevant cost in this case, although the tax on the decrease in net income would be a calculation in the relevant cost. So we'll talk more about this in different types of decision-making processes as we go. So, three types of costs that are pertinent to the discussion of relevant costs are: one, sunk costs, then out-of-pocket costs, and opportunity costs. Why are these important? We'll discuss a little bit further as we go, but there's a couple problems in our decision-making process that we are becoming more and more aware of when we make decisions. And usually we make good decisions, but sometimes there's some issues that distract us in our decision-making process. One of those things are sunk costs. Therefore, we have to be cognizant of the idea of sunk costs all the time, and then out-of-pocket costs and opportunity costs, two things that we need to keep into consideration, which may not always be in the accounting books exactly, and we're going to have to calculate those as we go. So sunk costs are the result of past decisions that cannot be changed by any current or future decision. Sunk costs are irrelevant to the current or future decisions. Now, sunk costs are something, once again, that we can't generally, as humans, avoid considering unless we consciously do so. We have a tendency to say, well, this cost that I put into the past, I put this into this thing already, and I cannot, it's really hard for us not to consider those sunk costs. For example, if we bought a $15,000 large vehicle that consumes a lot of gasoline in the past, and then the gas prices went up 5 times in the future, and we're considering to buy a new car or sell the car, we should take into consideration the value of the car, how much we like it somehow. If we can put that in the calculation, it would be hard to quantify that, but we'd want to put that in the calculation. We could put in there the price of the gas and that would cost over the years that we would use the car, as well as maintenance and those types of things should be in the calculation, as compared to if we got a new car. If we're thinking about buying a new car, what would be the cost of new cars, what would be the cost in gasoline in that car, and the repair bills in that car. We want to compare that. What we would not want to put in the calculation, though, is the $15,000 that we already spent. That's sunk. So at this point in time, we need to make decisions on the margin, as an accountant, as an economist would say. At this point inside, incrementally going forward, looking at the things that would benefit and not taking into consideration things that have already happened. And if times have changed, then we need to think about this point forward and these larger types of decisions. Also, we have the out-of-pocket costs, which are relevant. Our future outlays of cash associated with a particular decision, out-of-pocket costs are relevant. So if we're thinking about in the future, what will be our out-of-pocket costs within the two alternative methods? Those will be relevant costs that we need to put into consideration. Opportunity cost is another economic term, are the potential benefits given up when one alternative is selected over another. So opportunity costs are relevant. Opportunity costs are not generally in accounting records bottom lines. We consider revenue minus expenses generally. We do not generally consider what we could have gained from doing an alternative to what we had done in the accounting records. So notice accounting records do not generally take into opportunity cost. That doesn't mean the accounting records are bad or wrong. That just means that we need to take the accounting records as managers and add to it the idea of opportunity cost, meaning if we don't put the money here, what could we do it with somewhere else? It also includes things like our time. If we are spending our time doing this particular thing, we are giving up the time that we could have done to do something else. That is why an economist would basically say that everything has a cost, because at the bottom line of anything we do, even if something is free, we at least had to take the time to accept it, and we could have spent that time somewhere else. That is a cost. So management must also consider relevant benefits. So managerial decision, here we have an example, accepting an additional business. So the decision to accept additional business should be based on incremental costs and incremental revenue. Incremental amounts are those that occur in the company decision to accept the new business. So incremental costs, again, economists would call this making decisions basically on the margin. How much would that added thing, whatever it is, give you in terms of benefit? And so we know that as we get more stuff, the marginal benefit at some point tends to go down at some level, and we need to consider the relevant costs at the margin and the relevant benefits. So let's take a look at this example. Currently sells 100,000 units of its products. They are operating 80% at capacity. So key point, we're below capacity. The company has a per unit annual sales and costs as shown as follows. So here's the per unit, $10. Here's the variable cost, basically $2.40. Then we have the applied fixed cost of this $1.60, the operating income, well, the 60 and the 80, operating income being $1 after it's all said and done. If we multiply that times the number of sales, we got the 1 million minus the 240, and we come out to the 100 down here at the end of the day. Now, if we're considering one other sale, one person came to us and said, hey, I want a special offer, and I will do business with you if you give me a price less than what you are currently given. And the key to any problem like this is almost always going to be the fixed cost, the idea of the fixed costs. Remember what happened when we put the fixed cost into the unit price here. Fixed costs behave differently than the variable costs, meaning that a fixed cost doesn't change as the level goes up in capacity. So if we produced more units, the fixed cost per unit would actually go down. So usually what ends up happening is this fixed cost just got applied there. It doesn't go up in a constant rate. So if we sold more stuff, more units than 100 units, these costs would go up at a constant rate. These costs would not. We would have no more total fixed costs. These, in terms of per unit, would actually go down. Therefore, if these would not go up, they would be irrelevant in our decision making. And that's going to be the idea of most of these types of, a lot of these decisions. Take a look at the fixed costs. They act differently than the variable costs. So a current buyer of Fast Track products wants to purchase additional units of its product and expect them to another country. The buyer offers to buy 10,000 units of the product at $8.50 per unit, which is $1.50 less than our current price. So they're going to buy a bunch of units, 10,000, which is higher than our normal sales, but they want to buy it for $8.50, and the assumption, of course, is that they will not pay the full $9.50. And if that's the case, then the question is, if it's all or nothing, $8.50 or nothing for 10,000 more units, should we do that? And if we take a look at our calculation on the margin, we can take the sales here and the variable cost. Variable costs will still be applicable. And they're saying that part of the fixed cost went up to the other level. So we still have 10 cents here. And so we're going to take the $8.50 minus the $2.10 and the 10 gives us an operating income of $2 per unit times the units sold, and that will give us basically the 20,000 here. So we would come out in incremental dollars better off. Therefore, under these circumstances, at the margin, because of the idea of the fixed costs, we should take the offer. Now, again, there's some differences in that. There's some other things that we might want to consider beyond just the numbers calculation. And for example, one problem with this calculation could be that what if our normal customers heard about this and they said, well, we do business with you all the time. Why are you giving a discount to somebody else when we're the ones that do business with you all the time? They could be upset, right? So if we take that into consideration, that would be one other thing basically to consider within this calculation. Note that this is a similar calculation we can apply it to if you were trying to get into a hotel room for a price that is less than the price that's been advertised, and you go in there at the last minute, and if you know that the hotel is not booked, meaning they have open rooms that they're not going to sell for that night, whatever the cost of the rooms is taken into account, both the variable costs like the maintenance of the room as well as the fixed costs, which is basically the rent and the upkeep of the building. Now, at the margin, if you walk in there at the last minute and say, hey, I would like a room and it's this or nothing, and they know that they have a bunch of open rooms open, they have an incentive to basically give you the room at the cost of the maintenance, the variable costs, if there's nobody else that would pay full price for the room. That's a similar type of example that would happen. Remember, the cost of the room takes into account fixed and variable costs, but if you're making a decision at the margin and it's between covering your variable costs or getting nothing, then you'd be more likely to cover the variable costs in that